You are about to hand over thousands of dollars to the ATO. And frankly, you are doing it with a smile because you simply do not know any better. If you have over $300,000 sitting in your super balance and you are not actively exploiting the 2026 legal loopholes, you are essentially volunteering to fund someone else's holiday while your own retirement nest egg gathers dust. Welcome back to Aussie Super Secrets. Today, we are deconstructing the exact tactical mechanics of a $12,450 tax saving that high-income earners consistently leave on the table. We are talking about the difference between a massive tax bill and a massive wealth injection into your fund. By the end of this video, I will reveal the BPAY death trap that causes thousands of savvy Australians to lose their deductions every single year despite having the cash ready to go. You cannot afford to miss this. Before we dive into the technicalities of the 2026 thresholds, we must address the legalities. This is general information only and does not constitute personal financial, taxation, or legal advice. You should seek independent advice from a qualified professional, such as a licensed financial advisor or accountant, before making any investment decisions. Now, let's get into why the ATO is looking at your bank account with hungry eyes this June. The 2025 to 26 financial year has fundamentally changed the game for anyone earning over $135,000. With the Stage 3 tax reforms fully bedded in, your marginal tax rates have shifted. But the pain of the 37% and 45% brackets remains a reality for the high net worth community. The most potent weapon in your arsenal right now is the increased concessional contribution cap. For the 2026 year, this cap has been indexed to $30,000. That is $30,000 that you can move from a high tax environment into the low 15% tax environment of your super fund. Imagine a professional like Sarah. Sarah earns $200,000 a year and sits firmly in the 45% tax bracket. If she relies only on her employer's compulsory contributions, she is missing out on a massive arbitrage opportunity. By utilizing salary sacrifice or making personal deductible contributions up to that $30,000 limit, Sarah effectively borrows money from the ATO to fund her future. Every dollar she contributes above her employer's minimum only gets taxed at 15% inside the fund, instead of 45% in her hand. That is an immediate 30% gain before the market even moves an inch. But do you know the absolute worst thing the ATO can do to you if you mess up the timing? We will see that in a second. Now, let's talk about the carry forward or catch-up rules. This is where the real wealth is built for those with a total superannuation balance, or TSB, of under $500,000. If you haven't maxed out your caps over the last 5 years, you could potentially dump a massive six-figure sum into your super this year and claim a tax deduction for the whole lot. This is the ultimate tax minimization strategy for anyone who has had a high-income year due to a bonus or a capital gain. But be warned. If your TSB is $500,000 or more on the 30th of June of the previous year, this door is slammed shut. You need to know your balance down to the last cent before you attempt this. Many of you are sitting in My Super default options within major industry funds like Australian Super or ART. While these are great for the average worker, for a high net worth individual with a balance over $300,000, the percentage-based administrative fees in a default My Super option can be a silent killer. You need to look at choice or member direct options that offer admin fee caps. Why pay a percentage of your entire balance when you could cap those fees at a few $100s a year? It is a simple switch that can save you tens of thousands of dollars over a decade. But wait, there is a hidden tax that hits high earners specifically, and it is called Division 293. If your combined income and super contributions exceed $250,000, the ATO slugs you with an extra 15% tax on your contributions. It feels like a kick in the teeth, doesn't it? Even with Division 293, your total tax on those contributions is 30%. which is still significantly lower than the 45% top marginal rate plus the 2% Medicare Levy. It is still a winning play, but you must account for that bill when it arrives in your MyGov inbox next year. Do you think the ATO is going to remind you to take these deductions? Absolutely not. They are quite happy to let you overpay. That is why you need to be proactive. But there is a technicality that ruins more EOFY strategies than anything else. It is the BPAY death trap. Most people wait until the 29th of June to make their big contribution. Big mistake. Under Australian law, a contribution is only made when it is received by the fund, not when you hit send on your banking app. BPAY and EFT transfers can take 3 to 5 business days to clear through the banking system and the clearinghouse. If that money lands on the 1st of July, you have lost your deduction for this year, and you might even accidentally blow your cap. For the next year, you must have your capital moved by the 20th of June at the latest to sleep soundly. As we approach the climax of this strategy, remember, this content is general information only and does not constitute personal financial, taxation, or legal advice. Always speak to your tax professional to ensure these numbers work for your specific circumstances. The final secret to maximizing your return in 2026 involves the Medicare Levy surcharge. If you are a high earner without private hospital cover, you are being hit with an extra 1 to 1.5% tax on your entire income. By combining a super contribution strategy to lower your taxable income with the correct private health cover, you can effectively wipe out this surcharge while building your own wealth instead of the government's coffers. It is the ultimate double play. If you found it painful to realize how much money you have been donating to the ATO every year, you cannot afford to miss our next episode. This Thursday at 7 p.m, we are going to expose the 3 hidden fees that retail funds use to bleed high balance accounts dry. We will show you exactly how to spot them on your annual statement. Make sure you subscribe to Aussie Super Secrets and hit that notification bell, so you don't give the ATO or the big banks a single cent more than you legally have to. See you in the next one. Disclaimer: the information provided in this video is for general educational purposes only and does not constitute financial, taxation, legal, or home loan advice. It has been prepared without taking into account your personal objectives, financial situation, or needs. Before acting on any information, you should consider its appropriateness and consult with a licensed professional, such as a financial planner or tax agent. Specific results or future performance are not guaranteed. Copyright symbol 2026 Aussie Super Secrets. All rights reserved.